Can you tell us what debt service coverage ratio is and why why the lenders are interested in this number?
Yeah, so the debt service coverage ratio is a metric that the lenders look at to see how tight or how risky a deal is. So the lenders are going to underwrite the deal. Um, and in the case of multifamily, you have your rental revenue with your other income that you're collecting for pet fees and things like that to get to a gross income number. And then you have your expenses. You have your real estate taxes, your insurance, your repairs and maintenance, your payroll, your management fees, all of that. You subtract that from your revenue to get to your NOI. The DSCR, the debt service coverage ratio, is your NOI divided by your debt service. Lenders like to see a 120, 125 bare minimum, which means that you can cover your debt service payment. And debt service is your monthly loan payment or annual loan payment, depending on how you're looking at it. Which all those factors, amortization, interest rate, loan amount, all come, that's how you get to your debt service. And they want to see how well you cover your debt. And the higher that metric, the higher that number is, the better. If you're at 2.0, that means that your NOI is 200,000 and your debt service is 100,000, and you can cover your debt service 2 times. That would be, a very conservative, low risk loan for a lender to look at. If it's
Do
at
you guys have
one, yeah, go ahead.
is there a different DSCR target for a interest only loan versus an amortized loan?
Yeah, so they're going to look at, even if it is interest, that's a good question. Even if it is interest only, they're going to look at it as if it's amortizing, especially because all of these lenders are looking at their exit, right? Let's say they're doing a 5-year loan. In year 5, are you able to refinance the balance? And let's say rates go up 200 basis points. Are you able to refinance your balance and still cover your debt? So the lenders are going to look at all the sensitivity, and the exit is a super important thing that lenders are looking at that a lot of borrowers don't think about. They're looking at it today, and they're saying, "Hey, hang on a second. I'm covering. This is an interest-only loan, and I'm covering at 150. Like, why? Why is there any issue here?" Well, interest only might not be available at the end of your loan term in year 5. Let's say if you did a 5-year loan, and it might be a 25-year amortization, and rates might have increased by 200 basis points. Do you still cover your debt? Because if you don't, how are you going to get a loan out in the marketplace to pay me off, the lender? So, they're looking at that debt coverage ratio now, and then they're running sensitivity on it, reducing rents, increasing expenses, increasing interest rates, and making sure that you can still cover your debt.
That makes sense. So you said typical debt service coverage ratio that banks are looking for is like 1.2, 1.25, which essentially means that the net operating income is 1.25 times the whatever the mortgage payment is.
That's correct.
Got it.
The
So it's
higher
just
that coverage is, the better.
yeah. So you're just trying to see how well the property performs financially, that it's able to pay the mortgage payments comfortably.
That's right.
Got it.
Yep. 100%. And that's a
Now,
huge thing, especially on a non-recourse loan.
yeah,
Again, because you know a lot of times on these commercial loans, the sponsor has investors in the deal, and it's the property that's paying the debt. It's not your personal income like on your residential house, where I can
mhm,
see how much money you're making and understand that you're able to cover your debt.
right.
Property needs to cover the debt.
hmm hmm Now, initially, when getting a loan, how much does the buyer need to put down? I know it varies, but what's like a typical loan to value? And can you contrast between loan to value versus loan to cost?
Yeah, for sure. So let's just take a straightforward stabilized multifamily deal to start. That $10
Yeah.
million purchase price. The max loan in what's considered strong markets by lenders would be 80% of purchase price. So getting an $8 million loan on your $10 million asset or $10
hmm
million purchase price. Um, that's going to be your maxing out on leverage. All of your other metrics are going to need to work. Your DSCR is going to need to work. They're not going to go to 80% if it doesn't cover debt, right? So like
Right,
it
right.
needs to underwrite with strong sponsorship in a strong market. 75% is way more common,
Right.
way more straightforward. That's kind of down the middle.
Mhm.
But oftentimes what we're seeing in the Columbus market, at least, is people are buying this property for $10 million, and they think if they put $2 million of CapEx and capital improvements into the property, it's worth $15 million. So now we have, a $12 million loan or $12 million cost, and we might be able to get 80 or 85% of the total cost as long as it hits 75% of stabilized value. So
Mm.
oftentimes I'll be working on a value add multifamily deal, and we'll go out and we'll try to get 80, maybe even 85% of the total cost budget, as long as we can prove to the bank that once you're done with the work, your leverage level is still only 70 or 75% of stabilized
Got it.
value. So that's kind of how the cost versus value works together.
So loan to value is just the purchase price. It's percentage of the purchase price. So 75% loan to value is you're gonna need to put down 25%. The loan's gonna be 75% of the purchase price. Pretty simple. But loan to cost is when there's construction involved.
That's right. Yeah, and sometimes it's not on a purchase, right? Sometimes you've owned the asset for 5 or 10 years and you want to refinance. And then your value is going to be what the appraiser and what the lender ends up underwriting to on a value from a value perspective. When it's a purchase, value's easy. The market tells you what the value is. When it's a refinance, it's subjective. What cap rate do you use on this property? There's not an open market telling you what the value is. So it can be value or purchase price for loan to value. Loan to cost is very specific. It's your purchase price plus your costs, or just your purchase price, because that is the cost to buy the asset.
Thanks for joining us today. You can find more episodes at therealworkshop.org.